Hello students, I'm Vipul Mittal, and in this session I will discuss bond premium amortization. So you purchase bonds, you make an investment in bonds of another company and you get interest. That interest is taxable interest. The amount of interest that you receive on your investment in bonds of another company is taxable. You include that in your gross income. So for example, you invest $20,000 in bonds of IBM company. The company pays you interest, let's say $500. This is taxable. This $500 is taxable. Now, what if you pay premium to buy bonds? So you pay a premium. What is the impact on taxability of interest? Let's see. If a premium is paid to buy a bond, so if the par value or the redemption value is $100, but you are paying $120, you are paying $20 more. That's premium that you are paying. So if a premium is paid to buy a bond, the premium is part of the basis in the bond. So what is your basis in bond? So if, for example, if $100 par value bond you buy for $120, so how much you are paying? You are paying $120. And this is your basis in bond. So this is your tax basis. So tax basis of bonds is $120. Now there is a premium of $20. You may elect to amortize this bond premium. But if you elect to amortize bond premium, then your taxable interest is lower. So it is in your advantage to amortize bond premium. If you elect not to amortize, then more amount of interest is taxable and you pay more taxes. I'm sure you certainly not prefer that. So in this video, I've explained how to calculate the amount of taxable interest when you elect to amortize the bond premium. How it is amortized? Over the maturity period. So this is amortized over the maturity period. So if maturity period of bonds is 5 years, you amortize this over 5 years. If maturity period of bonds is 7 years, you amortize $20 over 7 years. So you amortize this $20, that is premium over the maturity period. And how you amortize this? By reducing interest. So you have made an investment, you buy bonds at a premium, you're getting interest. The amount of interest that you're getting is reduced by the amount of bond premium amortized. So what is the amount of taxable interest? So interest received is reduced by bond premium amortized, and you get to a figure of taxable interest. All right, let me give you an example of this. You buy a bond and you buy this on January 1 of current year. All right, and you buy this for $110,000. This is the purchase price. And the redemption price is par value, that is $100,000. This is purchase price. And redemption price is 100,000. You have paid a premium of $10,000. All right. So this $10,000 premium has to be amortized, and this will have impact on taxability of interest. The amount of interest that is taxable every year is reduced by the amount of premium amortized. Now, what is the interest that you're getting on this bond? So interest is 20% annual interest. Now, to amortize premium, you need to know the effective interest rate or yield. So the effective interest rate in this case is 16.1488%, and this is your annual yield. This is compounded semi-annually. Annual yield would be given to you in the question, but you can also calculate that. I have explained how to calculate annual yield in another video. This would generally be given to you in the question. And you're getting interest of 20% every year, and you're getting interest semi-annually. All right. So let's see the impact of all this. So you get your first interest on June 30th of current year. How much interest we are getting? So interest received is 10% of $100,000. This is the amount of interest that you are getting. And it is $10,000. This is the amount of interest that you have received. All right. And your annual yield is 16.1488. And this determines your taxability of interest, your annual yield. So your taxable interest is percent of your basis. This is for the entire year. So you multiply that by half and you get 8882. This is your taxable interest. All right. So although you have received $10,000, but interest taxable is not $10,000, it is 8882 because of premium amortization. How much is premium amortized? You have that formula. Interest received minus premium amortized equals taxable interest. Interest received is $10,000. Premium amortized we have to find out. And taxable interest is 8882. All right. So how much is the amount of premium amortized? 1118. All right. So premium amortized is 1118. Taxable interest is 8882. And interest received is $10,000. Although you have received $10,000, but amount taxable is a lower figure of $8,882. So let's calculate the basis. So basis in bonds on January 1 current year was $110,000. This is the amount that you paid, and this is reduced by premium amortized on June 30th current year. Adjusted basis you're getting. This is the basis as on July 1 of current year. Right. Now let's do for another 6 months. Now we are doing this calculation for July to December of current year, and interest received is $10,000. That is 10% of $100,000. Taxable interest 16.1488% of the adjusted basis, that is 108882. Multiply that by 1/2. You get 791. All right. So premium amortized is difference of these two. $10,000 minus $8791. You get $1209. Right. So taxable interest for current year. This is the taxable interest for the current year. What is the adjusted basis of your investment? Adjusted basis on July 1 current year is 10,882. Reduce this by premium amortized. That is 1209. You get 107673. All right. If you purchase bonds at a premium, you amortize that amount of premium over the maturity period of the bonds. The amount amortized reduces the amount of taxable interest. So now a lower amount of interest is taxable. You receive more, but amount taxable is less because of premium amortization. And to amortize premium, you need to know annual yield. All right, students, I hope this session was helpful. We'll connect again. Goodbye.